Hi friends, Simon here from InformedTrades.com. In today's video, we're going to talk about the dividend growth rate and what that means for income investors. Let's get started. Okay, key points. We'll define the dividend growth rate, talk about what exactly that term means, why it's meaningful for income investors, and why those who are focused on generating income really want to pay attention to this metric. We'll look at the historical performance of dividend growth stocks, an example of usage of how you can find dividend growth stocks using a stock screener. Okay, so what exactly is the dividend growth rate? It's basically a way of looking at the annual average growth rate in dividend per share. So if a company starts out issuing $1 in annual dividends per share, and then next year it's at $1.10, that's a 10% growth rate. 10%, from year to year. And so you're looking at the average. How much is the company increasing its annual dividend on an average per year? That's what the dividend growth rate is basically trying to calculate. Usually it's an average of a 3-year period, so when you're using stock screeners or seeing that number reported in various news outlets or various financial services, often they're looking at a 3-year period. However, calculations will vary across services, so be prepared to see some people saying the stock has a dividend growth rate of 8%, other people might say it has 8.4%, some people might say it has 7.6%, whatever. That's because of various ways of calculating. Are they calculating it year over year? Are they calculating a 3-year average or a 5-year average or a 10-year average? Are they using least squares regression method, which is a little more mathematically involved? So there's a bunch of little nuances in how dividend growth rate is calculated. It's not exactly a fully standardized metric in that regard. So it is something to pay attention to or be aware of and explain why you might hear different numbers being reported across the web. Okay, let's go through an example, and that sort of illustrates, one, how it works, in case it hasn't been clear so far, as well as why it'd be of great interest to income investors. On the screen right now, you're seeing the share price, the dividend growth, dividend per share of a company known as Fortis, a Canadian company. You see the company has been increasing its dividend per share, since 1972, from 1972 to 2014. Okay, so you can get the idea. If you bought a share in the early 70s, you're going to get 9 cents per share. In 2014, you're getting a dividend of $1.28 per share. Now, let's say you invested here at 2000. Okay, at 2000, the share price was about $8 per share, and you're getting 40 cents annually per share. So roughly 40 cents divided by $8, we're looking at a 5% dividend yield. Okay, let's say you bought a bunch of shares here, you're getting a 5% dividend yield. If you held on until 2014, those shares, which you still paid $8 for, are now giving you $1.28 per share in dividends. So really, the dividend yield is essentially 12.5%. So the point is, as the dividend growth rate increases, your effective dividend yield is also increasing. You're getting paid throughout the time, you're getting paid to hold it, and the increase in dividend growth rate is increasing the effective yield based on your share price, assuming that is that you held it over this whole time. And that's where you really get to see the power and the value of dividend growth rate and why it's an important metric for investors who are really interested in gaining income. Also worth noting is that you can make an argument that dividend growers tend to outperform. This is in terms of share price, or I guess in terms of in terms of share price and the dividends being issued. On the screen right now, this is a chart from Ned Davis Research looking at 1972, so the start of the post-Bretton Woods era, the modern financial system. Dividing stocks into S&P stocks into 4 segments. The highest yielding, which is top 20% dividend yields. Stocks in the S&P 500 that are not yielding dividends, dividend payers, dividend growers, initiators. Now this is a sample portfolio that calculates rolling over those metrics over the past 12 months. So it's rebalancing every year basically, and it's not factoring in transaction costs, which is a pretty significant caveat, especially in these two categories where the numbers are less than 1% apart. Transaction costs, depending on the size of your portfolio and such, may actually alter some of these numbers. But you can still see that dividend growers are doing pretty well. It's also assuming that it's calculating dividends that are paid out, but it's assuming you're not reinvesting them, that you're just holding the cash that's being given. But if you factor out the dividends you're receiving, plus the share price appreciation of these dividend-growing stocks, you can see that they're doing pretty well. So you can see a case that this is, maybe the best way to invest these dividend-growing stocks, in the sense that you're going to get capital appreciation and you're going to get dividends. And historically, at least from Ned Davis research here from 1972, you can make an argument that this is outperforming, at least in the segment of looking at large cap stocks. If you want to invest in just S&P 500 caliber stocks that are included in the S&P 500, this might be one way to go, or at least something to think about. Now, if we're looking for dividend growth, the stocks with a dividend growth rate or with a high dividend growth rate, how would we find them? You can use a stock screener. Dividend growth rate's probably on a lot of screeners. I'm sure it's not quite as prevalent as dividend yield. So you're going to be able to find dividend growth rate on a lot of stock screeners. Not as easily as you can find dividend yield, but it should still be fairly widely reported. Guru Focus, a premium screener I use because it has a whole bunch of different metrics. Here's a sample screen I set up. I wanted to see stocks that are yielding 2.5%, that have a dividend growth rate of at least 15%. Guru Focus uses a 3-year data set, so its dividend growing is 15% per year over the past 3 years. I'm also adding on some fundamental filters. I want to see a market cap of at least $1 billion, a debt to equity ratio of 0.4 or lower. So I really want to see companies that are not overburdened by their debt. When I see a company that's issuing a lot of dividends and has high debt, to me, that's a little cause for concern. I want to see that they have a lot of cash, a lot of current assets, and that they're paying their dividends somewhat easily. The dividends are truly reflective of their earnings, of their free cash flow, and that they're not just borrowing a lot of money and paying it out as dividends. And excluding OTC stocks being a little on the safe side there, as well as with a market cap of $1 billion. And you can see there are 16 companies that meet those criteria. Most of them get filtered out when you specify a dividend growth rate of 15% with the current yield of 2.5%. I played around with this. You can even make the number smaller if you increase your starting yield. But you can get an idea here. If they're yielding 2.5% today and their dividend growth rate is 15%, you can sort of project out into the future. Now, it's not a guarantee. Business conditions may change. They may lower their dividend growth rate. But you can get an idea of what kind of stock would be, how much that stock will yield, 5 years out, 10 years out, and whether that's something that you'd be interested in holding on to. So that's the basic idea. Dividend growth rate, pretty important, pretty valuable metric, especially if you're an income investor looking at the long term. Any questions you have, anything you want to add, join us at informedtrades.com. If you want to help us out, go to informedtrades.com/donate. You can make a contribution there. And of course, liking this video on YouTube, sharing it on Facebook, Google+, also helps us get the word out, helps us keep growing. Best of luck in your trading and investing, and we'll see you next time. Take care.